Everybody. Happy Aloha Friday. Happy Aloha Friday. Happy Good Friday. Um, I know everybody's probably getting ready for the weekend and family time. But we figure we still have the call just to check in. Probably be a small room, but we can talk about some things that are kind of changing in our space and then move on to anything that anyone needs help with. So why don't we start with uh
trying to find a lender that will accept short-term rental income for 1 year. 'Cause going through the banks and they're all asking for 2 years of income. So I don't know if that even exists out there.
so I you said that the banks are asking for 1 year's worth of income. Is that what it was?
Yeah, now and then the house we're living in. So the debt to income is high, but they would allow me to use the 1 year of income. That would like significantly boost my qualifying income. But the banks are saying they want 2 years of short-term rental income instead of 1 year. I don't know if there's a lender out there that does that with 1 year.
Yeah, there's a lot out there. I mean, because we don't go off of DTI, right? So we could take a look at it. What is the interest rate that they're giving you guys in terms?
Oh, the terms. So, I mean, they got different introductories with interest only for, I think, 5 years, but the terms were, the teaser rates are low, but I think the set rate is 4.5, but it also depends on the prime. You know, there's an added on percentage to whatever the prime rate is.
So if it's at 4.5 plus prime, what is prime right now? Is it 2.5? No, Alex, you know prime? Okay.
But I think even then the interest rate, I mean, as long as it's not ridiculously high, it's not that significant because the way it's going to get paid back is from rental income anyway. You know what I mean?
Yeah. Yeah.
Of course, the lower rate, the better.
Well, Gene, I'll call you guys after because we might be able to help you guys on yours. Is it in rural as well?
Say again?
Is it in rural as well?
No, the property I'm trying to get the HELOC in is our principal or primary interior point.
Okay, we might be able to help you on that one. I think I have a couple options, so I'll call you after later today. I'll call you guys. Yep. Perfect. Awesome. What's up, Roderick?
Garnamoto, what's cracking?
He's my daily dose of caffeine.
That's caffeine, bro. Got the smoothie going on.
Nice, I like it.
Staying fit. 3:30 a.m. comes early, Corey. You know how it is.
3:30. Oh man, I'm going to sleep around that time.
I think Danny got it.
No. Well, hey Roderick, did you end up going to Daytona, or not Daytona, but what was the neighborhood you're in?
Yeah, we bought in Holly Hill, right next to Daytona. We went out there 3 weeks ago and closed escrow, and I lined up some contractors. I went and stood in front of Home Depot and just like met people for like 2.5 hours. And I got a whole list of good guys.
Oh, that's awesome. What time did you go?
I tried to get there about 7.
Okay, yeah.
I
Yeah.
was there when it was still dark over there, so maybe even earlier. But anyway, it was good, man. It was
Yeah.
great. I found a great handyman. He's been working on it. I gave notice to the downstairs unit, and I gave her like 60 days notice.
Yep.
And she told the handyman she was going to sue me because I gave her less than 30 days notice. And I was like, I need to remind you that you still have 55 days left. Like, she was just so little frazzled, but we got to rehab that unit. It's so bad,
Yeah. Yeah. Well, I'm glad you had to go down there then. So I've been hearing a lot of for the short-term vacation rentals, like that space is growing, right? I was just on a call yesterday with one of our capital partners, and he was saying like that's where he sees the next big opportunity. So yeah, I think that was a good buy.
The Gulf side. So I'm over on the ocean side, but if I think over on that Gulf side, like St. Petersburg and like all up that coast, man, there's tons of like little boat dock houses that needs a little bit of work, and you can score them for under 500 and fix them up, and they'd be worth, 700,000-800,000, nice.
Yeah. Well, that was actually, I think that's a good way to look at it, because if you know that you're in a state, like if you look at it from the macro to the micro, the state of Florida is appreciating, right? Like in general, like that state, like there's people moving in, industries kind of setting up headquarters out there. So, and then that should bleed like into the major cities and then the outskirt neighborhoods, because you guys are not in Daytona, but kind of right on the cusp of it, right? So is
Correct.
and are you starting to see appreciation already spill over from Daytona? Or
I haven't been tracking anything. I
Mhm.
just we're tapped out for right now. I got to get the thing.
I just gotta fix the house.
Yeah, get the rents up a little bit, and then we'll be in the market again. So I really want to go 5 units and up next time, or commercial. No more of this single family nonsense.
Yeah. And that's where believe it or not, like when you go bigger, sometimes it gets a little easier, right? It's easier to secure the financing, because you look at it as more of a business, right? The whatever you're like, if it's a commercial building, they don't look at you too much personally. Like if the numbers work, then they'll fund. So nice, man. Keep us updated on that one.
Oh, and props to JD. I don't see he's on here, but man, he came up and we sat at the beach and talked story, and he's the one that recommended Turbo Tenant for managing your tenants. So it's a total organized platform. It's great.
Dude, that makes me so happy.
Yeah, guy's top notch.
Oh yeah, JD, he's a stud, man. Yeah. Oh, that's good. I'm glad you guys are able to connect. We're in this together at the end of the day, right?
Great. Where's Kikoa today?
Kikoa's in New York with the family. So I'll take it over.
I think he's in Central Park right now.
Oh yeah.
That's what it looked like this morning.
Oh, does anybody else have anything they need on the line?
I need a developer for my listing in Wanalua Gardens.
Yep. If anybody's looking for some lots coming up for sale in Hawaii, in Wanalua.
Yeah, in Honolulu, Wanalua Gardens area, super rarely available, single family houses in that puka. Big development though, like people who do grading and it needs a new soils engineer report. The soil has to be compact. It's a steep slope, but a really cool development opportunity.
Yeah, it's definitely a bigger project, but I think there's about like $1 million in potential profit if you get it done right.
How many lots?
The 9-unit CPR, 8 approved dwellings, and 8 the permits for sewer and water have been done. But it's 3.3 acres, R5, but a lot of the land is in the valley off of Wanalua Stream. So the vision is the two dwellings are there existing. It has 5 rentals in those 2 dwellings, not legal, it's house hack. And that brings in about 10,000. Seller lives in one of them. So if he moves out, it'll bring in about like 14,000 a month. And then that's just to hold the property, helps offset the costs. And then you have to tear those down eventually to widen the driveway. And then the bottom, which is a majority of the land, lot 9, that's flood zone, but it's not, the whole project's not in SMA, which is surprising. So that makes it a bit more appealing. And the vision was to have as a bike path with a park, make it a community.
Did they already cover like park dedication for that?
They're just paying the park dedication fee. But so
Okay.
if they did the park, that they use that land as the park dedication, you have to open it up to the
Oh.
community. And they rather just pay the fee, it's cheaper. And then that comes like its own little HOA oasis. Cause it'd be a couple acres of like biking and walking with,
Mhm.
you can make it real nice.
What do you need, Ashley?
I need a developer who's used to a bigger project like this. I mean, I've already sent this out just this week because we just listed a couple days ago, and I've sent it out to some of the people here and others, and it's in the works. There's a few prospects, but I just know it's a big project. Not everyone's going to be able to take it down. I have the CPR docs. I have a basic assessment on the project already drafted that explains the slope, the grading. I have the grading map. And then, yeah, basic explanation of it. And then we can show it. You just need to see the ground size. You can't see it from the street, so driving by won't give you a good visual. So if you know of any developers or can partner with any big developers that are familiar with this.
I just
Would-
texted you my boy Frank's phone number. He did something similar for a real estate investor in Honolulu. This like older Chinese lady who's got tons of units. He like jackhammered into the entire hillside, put in the roads, all the infrastructure, everything for her. And he traded it for a lot. So you might not necessarily have to pay him. You might be able to give him like equity or something. I don't know. You guys talk.
Oh, that's a
So have him partner with somebody who might be interested, and yeah,
He's open.
that's
nice
cool.
guy.
Thanks.
that's a good idea.
Appreciate it.
Yeah, that's a good idea. Are they willing to sell it individually or just as a whole?
I mean, yeah, they're already CPR'd, so we could in theory sell them individually. We're currently listing the whole project though, because having that 9th lot, that's where a lot of the acreage is. And that's going to create sort of that whole community. Like, how are you going to upsell and elevate this ARV for these properties? That is a good aspect. Like, it's a big aspect of it, but we could,
Yeah.
in theory.
Yeah, you kind of don't want to just sell one-offs because then you need like 9 buyers instead of just one, right? And then if you sell 2 separately, it kind of ruins the chances of getting a developer because now they don't have full control of the entire property, or right? So
Yeah,
Okay.
and you gotta like the soil. So all of Moana Lua Gardens area, that whole valley, all of those houses on the ridge, they all have settlement issues. So every couple years they have to do things to mitigate the settlement. And this valley at one point when it was being developed was sort of the debris site. So underneath all that soil, when they built House 2 is just built in 2010, that they did the soils engineer report, but they didn't account for decomposition of materials underneath because they didn't know. So that house is already, you already have to mitigate that in the overall project, but now at least this owner has already experienced it. It now knows that. So when you do the new soils report, you can put in the right compact fill, you can put in the right soil. So you already have to tear it down. Selling each lot would individually be tough because you have to tear down the front house, widen the driveway, and then who's going to buy that one while the other ones are being built out?
Yep.
Yeah. It would be,
well, if anybody knows any developers that might be interested in it, and I think it's 9 lots, Mauna Lua, and what do you have the price yet? Oh,
yeah, it's listed 3.5, and sellers willing to do financing with at least 55-60% down.
okay, perfect. 50, what did you say, 55 or 65?
55 to 60% down. Obviously, they that would have to be all negotiated, but I know that's what he's landed on for down payment. Normal commercial interest, like whatever the going rate is for commercial rates or higher, I assume, again, has to be negotiated. 2 to 5 year term potentially for owner financing, depending on the situation. JV might be possible, but I don't know if they'll do a JV. And then we still have that Kaava lot too. I just got information out to people from Coffee Talk last time, but Kaava lot, that's a lot less of a project development. That's 29,000 square feet, R5.
Yep. Nice. Yeah, it was it's actually really cool to see the bless you, that from last Coffee Talk, when you put it out there, how much interest there was, right? So it's good to know. I know sometimes like live on the call, it's hard, it's a little hard to unmute and say, ask the questions you want to ask. So that's why it's always good. We can take it offline if people are uncomfortable. But if you are interested, or if you know anybody, then please reach out to Ashley.
The Coffee Talk people who are interested from last week was so abundant. We didn't even go on market yet because we're still lining up showings and getting information out to people.
Nice. I love it. Yeah, I think it was the Coffee Talk discount you put out there.
Coffee Talk. We're going to, when we go live, if it doesn't sell off market, we're going to go live at tax assessed. I think we're going to do 530,000. And right now, selling off market like 459, which is, if you look at any of the lots, especially right across from the ocean, it's a good deal.
Yeah, it's a nice lot. All right. Well, I wanted to have Alex talk about some of the stuff that was discussed yesterday on the NPLA call. So if you have notes, dude, you want to share with the group? Okay.
1 second here.
Which is going to lead us to, because there was some updates obviously about the rates and stuff. So we can discuss like kind of what are plans, what is everyone's plans that they're doing now, or if you're not thinking about it, maybe it's time to start thinking about it and having some plan Bs in place just in case.
All right, guys. So yeah, we had a great call yesterday with the MPLA. It was pretty interesting. We kind of discussed the bill. Is anyone investing in California? Anybody? Because if not, we're gonna just skip over that.
I think it's good to put out there anyways, because we did spend a lot of time. So
okay, so well, there was 2 bills. The first one looks like it's not even gonna get past the House. So that one looks like it's gonna die, and that was the one that was really gonna affect
capital gains tax, right?
Yeah, capital gains tax for up to 7 years, and it wasn't just for investors. So like, as long as it wasn't, if it was your, like, say you already owned a home and you bought, another home within 2 years of that. Well, that second home that you,
It was like I think it was like the first 5
up to 7 years.
Yeah.
You would be
taxed at 25%.
Yeah, on that aspect.
Yeah.
So that one's pretty interesting. That one's not getting any traction. Can you guys hear me?
Now we
Can
can.
you hear me?
Yep, now we can. Yep,
Okay.
Now we cannot.
Okay, guys. Now,
Now we can.
can everybody hear me now?
Yes.
Yeah.
Okay, sorry. So yeah, the new one's called AB 2710, and it's any SFR rental property that's being resold would have to be offered to the current tenant living in it, or a list of eligible buyers like nonprofits that rent to low-income renters. If they don't take it, then you can go to the market. Now, once you go to market and it goes under contract, then you have to re-engage all of the nonprofits again and give them the opportunity to take the property at the same price. So it'll be a whole bunch of back and forth. Logistically, it'll be a huge pain, and it'll really slow down the transaction process. And then also it can kind of, with your tenant, you could lose time there, you lose time with the nonprofit, especially if they don't perform. So it's something that we're keeping an eye on, but it's starting to get a little traction. So that's something that we're watching out for in the MPLA, and that's in California right now.
Wait, that's any sale that's tenant occupied or is considered an investment property on the note or in tax records or what?
Anything that's a rental property in California. So anything that's tenant occupied.
You can't go live on market to capitalize on multiple offer situations. You have to offer a price to the tenant first.
You have to offer it to them first. And
Can
they
you
have
price
to
it
act
high or
on
did
it.
they not talk about that?
And then it's probably you have to probably get an appraised value, and you're not going to probably be able to offer over appraised to the tenant. And then also after the tenant says no, you have to go to a list of nonprofits that buy properties and sell them to or rent them to lower income. So
That passed or is that a discussion?
No. This is just a brand new one that's getting presented in California.
Oh, okay. That's crazy.
Yeah, no, that one's definitely crazy. But they don't think they'll get a lot of traction, but that's the new one that kind of got submitted and is being pushed a little bit, but they don't see it getting traction, but it was something they wanted everybody to be aware about. And then after that, we talked about the rates are going up, but the market's continuing to go up due to housing shortage. So everyone feels pretty confident in the housing market. Obviously rates are going to affect some buyers. One of the things we spoke about was they're really a lot of the bigger guys are really focusing on trying to find trends between what's going on and like leading indicators of where the market is going, and it's really tough. One of the only things that they found right now is that there's a big parallel between our market today and back in 1987, right before they went into Black Monday. So that's something they're worried about, equities like plummeting, but as of right now, everything's still on the up and up, but just be aware that there's a lot of parallels between our market today and where we were at in 1987 before Black Monday. Go ahead.
No, go ahead, bro. Keep going.
Okay. We spoke about, and then it said the word, we talked about this. You either believe that the interest rate is transitory due to multiple things. We talked about COVID still being one of those factors. Obviously that one's kind of going away, but now we have the Russian invasion, the trading and supply chains, the issues that are going on there, causing inflation. So, and then which is also causing our interest rates to rise as well to keep up with inflation. We talked about the removal of liquidity in the market, but there's been a removal of liquidity in our space. But at the same time, with the removal, there's been an influx in capital coming into our space that's not as, restricted, such as like insurance money, true private money coming in from big investors trying to place it, those types of things. And then we also really covered that, look, everyone really feels that there is a lot of rate increases coming. So whether it's you're working with private money, institutional money, bank money, the rates are going to rise, and it's going to be something that you're really going to need to keep a pulse on. And I think that'll kind of help lead into our discussion that we're going to talk about today. And, this is something that we talked about because majority of the group is lenders in the MPLA and different service providers, but we talked about as lenders, we need to make sure we protect ourselves from deals that we do and the terms that we offer, just to make sure, because we don't know where we're going to be in 6 months on different assets. So making sure our borrowers have multiple exit plans, that they're not just relying on one exit, because by the time they get to that exit, let's just say it's a DSCR.
I think you switched to your headphones, Alex, because we can't hear you again.
Oh man, that was good stuff too. You're saying, okay.
Corey's here.
Come on over here. I was,
Doing good. Okay,
I can
so
hear you. That's why.
real quick. So as lenders, we need to make sure we protect ourselves with deals that we do and the terms we offer. And the big emphasis on that is so much making sure that our borrowers that are doing deals with us, what their exit is, and making sure that's a viable exit. So like if we're going into a rehab deal with somebody and their plans to make it a long-term rental, you know, what are they planning their rate to be at for this long-term rental refi? Because right now, you know, they're already at 5.5 to 6. In another 6 months, it could be 7.5, 8% on a DSCR loan. We just don't know. So it's making sure that there's multiple exit strategies for a deal to make sure, one, we don't get stuck holding the note and our client doesn't get stuck in a deal and isn't able to get out of it. So that was one of the big things. And then we really dove into deep into just the DSCR product. So there's two really big guys in the MPLA that, you know, are doing multi-billion dollars a year in lending in our space, and DSCR is one of their big products. And so one of them says DSCR is going to be an interesting product, thinking about the volume. One side's thinking the volume is going to lower by 50%, you know, for people doing DSCR loans. And the other is the opposite. He thinks the volume is going to increase on the DSCR loans due to the fact of the amount of landlords that own property out there already that have untapped equity, that say, like maybe Gene, for you example, they can't tap it due to DTI restraints, but they can tap it with a DSCR loan. So the DSCR loan, they feel like that's going to be a big opportunity to go tap this untapped equity with current landlords. But at the same time, with new landlords coming in, it's going to be a little bit harder to get that new business, and it's going to be going out and getting business of people that are already established. So it was a great call. We talked about a lot, but I'd say the biggest emphasis is rates are going up. They're going to continue to go up. So really, you know, when you're going for your loan, especially if it's a DSCR loan, you know, account that maybe even in the loan process, you may get quoted at, you know, 5.5, and by the time you close, you know, 30, 45 days later, that might be 6.5. And it's not, you know, a lender trying to do bait and switch on you or any of that. It's just truly what the rates are doing, and they have to go with, you know, what they can sell the notes at. So because lenders aren't going to stay in business if they're lending money out and then they're having to take a discount on the stuff they're selling. It just won't work. But so just make sure that we're all aware about that. Make sure that we have multiple exit strategies for any deals that we're doing, especially if the primary focus is to make it a long-term rental. Now, if you're doing Airbnb, obviously it's going to be a little bit different because your numbers are going to be a lot greater than, you know, a long-term rental, but just definitely being cautious.
Right on. Yeah, so I think the what we got out of NPLA, and I wasn't able to stick around to the end of the call, so thanks for taking notes, dude, and sharing. It's definitely, we have to keep eyes on the interest rates, especially, and like Alex said, like the DSCR, because let's say you're gonna do a bird deal, right, where you're gonna buy it, fix it, and then rent it out and do a refi. But you might go into the deal looking at it on both ends, like what is the takeout going to look like? Okay, I'm going to refinance it. If I can get a loan, a DSCR 30-year fixed rate at 5.5%, you know, my DSCR should be 1.25, so we're good to go, right? But by the time you've finished renovating the property and initiating the refi and then closing the refi, that could be like 4 or 5 months later. And what they're saying is that since it's so volatile, the rates and the environment we're in, is that we should all be looking at, okay, what if the interest rates do get bumped, you know, like a full point? Is my DSCR still gonna work? Are my numbers still gonna work, right? So it's trying to look ahead so that you don't get stuck, you know, with a property that was a good deal 6 months ago, but now when you're trying to exit it, it's no longer feasible. So having multiple exit strategies, like, okay, if I can't refi it out, can I sell it and still make profit, right? So having multiple exit strategies now more than ever is, I feel, important on both sides too. If your primary exit strategy is to buy, fix, and sell, then great. But what happens if the market that you're in slows down dramatically because of the high interest rates? Are you able to still rent it out? Are the potential rent that you can get, is that enough to cash flow and hold it long term, right? So just being more hyper aware of everything. Like we've been in a nice market for the last few years, where like pretty much everybody's winning, but we can't assume that's going to continue that way, even though with the rising interest rates, it seems that since we are in such short supply and there's still major supply chain issues out there, then the housing market, may slow, but we shouldn't head into like a recession within the housing market. Now, the economy as a whole, they're talking about, we could very well be in a recession at the end of the year. So just keep to the fundamentals, I'd say, is the best the best advice. Now more than ever, stay disciplined, but definitely don't stay on the sidelines. So was there anything else on NPLA? No? Okay. All right. Well, with that too, I guess the main thing that for us looking ahead is, where is the opportunity when things are kind of changing, right? And DSCR for us now, I believe we start at 6%. And just to recap, DSCR stands for debt service coverage ratio. Sometimes in like commercial, they refer to it as DCR. As the lender, we always say DSCR, but basically it's how much is the asset producing in income versus its expenses, right? So it's a measure to measure your cash flow, basically. So a DSCR of 1 means there's no cash flow, whether positive or negative. Basically, you're breaking even, right? If it's a DSCR of 1.25, then you have about well, let's say like if you're bringing in $1,250 in rent and 1,000 is going out, that's a DSCR of 1.25. Most lenders have a threshold about 1.25 before you start getting bumps in your interest rate and hits to the leverage, if that makes sense. Does everybody understand this, or does anybody have questions? Because the DSCR loan is kind of a newer product, but it's a lot of lenders are coming out with DSCR products. So I can see, after thinking about, I think it was John Beecham, you said, from Turok.
Yeah.
He was the one that's saying that 50% of the DSCR loans he feels will shrink by 50%. And I was trying to think that through with Alex the other night, like why would he think it's gonna contract that much? And I actually still don't know his reasoning behind it. Did he give a reason?
His reasoning on the DSCR deal is falling is because they're not going to be able to qualify due to the rate increase. So with the rate increase, because every 0.5%, 1/4% really matters. So he feels that we're going to lose a lot of the deal flow due to the clients not being able to qualify for a DSCR loan because the rents aren't going to be able to match the increase that's been adjusted on the values.
Yeah. Okay. I remember now. So we have kind of two things, right? Like most markets have appreciated substantially. So the buy-in now is a lot more expensive, right? And I think the rental, the appreciation in rental, how much you can rent, it didn't appreciate as much. So there's already that gap there. Plus we have the DSCR interest rates and across the board kind of going up. So it's making it harder to qualify. So if your lender has a DSCR minimum of 1.25, then that's going to be that might not be feasible anymore, when about 6 months ago the numbers did work, right? So I think that's why he was saying that. And the reason why, even though we're in the housing industry, but we do have to keep eyes on the equity markets and what's going on with that, because that's where a lot of our money is coming from into our space, so it comes from Wall Street and some of the big institutions. So if they are getting or if they're feeling a pinch or a squeeze in the different kind of branches of their business or profit centers of their business, it can spill over and affect us. Like during COVID, since the market just tanked, and it tanked so fast, they had to stop the market. So a majority of those lenders had to stop business, and some of them went upside down and never came back. So we do have to keep eyes on that, and I don't see that happening as fast as it did in March of 2020, because that was a disaster. Like the market just went straight down for like a couple weeks or a few weeks, and then started to come back up. So but it was good because we got a good glimpse of what could happen, and so we got to ride a very strong bear market. But since it was like kind of a black swan event, it just lasted like a few weeks. But in a longer recession, I guess it kind of prepared like us to see what would happen, right? So the first thing is the industry loses liquidity, which is not good for everyone across the board. There's less money out there, right? Interest rates are higher, so there's less buying power. So we do have to keep eyes on the market, and nobody controls the market. So all we can do is try to look ahead, which is why calls like the MPLA and this call here, sharing with you guys, I feel it's really important. So any little step ahead you can get could save your business, and it's always, we don't want to be doom and gloom and stuff, but we always want to be forward thinking just in case. We never want to see someone get stuck in an event that could have been, I guess, I don't know why I can't think of the word, but prevented. Yeah, could have been prevented. So does anybody have anything to add to that topic about the environment we're in, changing, rising interest rates, the housing market, even the equities market? I know we have. And do we have any anyone on the line that's kind of in the broker position watching these interest rates? I see Justin's on.
He is there. Guys, does anyone have what is some of your guys' plans, for the next year for investing, and what are you guys watching? Like, are you going to stop investing, waiting to see what the rates do? Are you going to try and start getting your money out or getting money in as quick as possible so you can get it at a lower rate? And so trying to go acquire a few things right now. Like, what is everybody's strategies right now that they're feeling? Daniel or Tay or Miss Ann?
Oh, Daniel's on.
Anybody want to? Gene?
Yeah, I'll chime in. Right now we're raising more money. That's one of the reasons to get the HELOC, and then probably pull money out of another short-term rental that we have. Because I'm seeing the prices are dropping in the markets we're looking at. We're looking at Tennessee and just east of Galveston on the beach. But these prices are dropping, so we're like, okay, let's round up some money and then kind of just sit on it for a little bit and see where the prices go, and then jump back in and get in. Yeah, the rates are going up, but as long as the numbers cancel out, so this year we're just focusing short-term rentals. Probably next year we'll go long-term, depending on what everything looks like. But we're just watching prices drop and trying to get some money together.
I like that. I like Gene's strategy. I think I side with Gene. I think maybe now's the time to start doubling down and raising capital, just staying ready, because the and then that day may never come for the housing market, you know, but what is that gonna, it's not gonna hurt to have capital kind of on the side reserved, right? And just in case, ready to strike. So I like that strategy. I think that's better than sitting on the sidelines, because there's definitely no opportunity on the sidelines. I think that's a good because like we can look at it two ways. One is like, okay, let's sit on the sidelines and not do anything. Like that's I think that's a little bit more fear-based decision making, you know, instead of logical, where there is a very good chance that the housing market may not even feel a correction. I mean, it might slow down, but not a substantial pullback in values. And plus, we're a little bit more healthier as an economy as a whole, which Ashley was saying this early on in COVID, and she was right, and I was totally wrong with because I was thinking like, this might get ugly, but the fact that the supply and demand has always been what answers the question at the end of the day. So is anybody right now in the middle of a bird deal? I know, Daniel, you guys were doing a bunch, I think, or you were doing a bunch in Indy. Ote is doing some.
I'm in one right now, yeah. But it's like my play. So my play for the bird deal over here is it's a single family home in Hawaii, but it's gonna cash flow even right now for like the next 2 years. And then hopefully it'll appreciate like in the next 2 years, I'll hold it for 2 years, and I'm gonna probably 1031 that into like a commercial building or something in Kansas City. That's my play right now. Cause let's say like if you've got like $1 million in like $1 million home in Hawaii, cash flow even, no cash flow, right? But you're into it for like zero. So if I were to sell it as a flip, you're gonna pay like a ton in taxes or whatever. But then if you can 1031 that $1 million into like another market, like where we're looking in Kansas City, and we're now looking like 8 caps for like some retail centers. So that basically it goes from like a zero, basically a wash to like basically like a $1 million will give you $80,000 in NOI. And after debt service, you're probably looking at maybe like a $40,000 cash flow a year. So maybe like $3,000, $3,500 a month on actual like cash flow. So you're taking that single family home that's just a home that just is appreciating, but not really cash flowing. Then you can 1031 and not lose any taxes into like a retail center or something in the Midwest where you get a good cap rate, and then now you got like a cash flowing asset. So that's kind of like our like mini hybrid bird strategy over here.
Oh shoot, I love that. So because usually, right, it's not that favorable to do a cash flow deal or a bird deal here in Hawaii. But if the plan is it's even longer term, right? But there's different little exits along the way. So you bought it, fixed it up. Yeah. Did you already refi?
So I'm like at the closing table right now on the refinance. So it's I'm basically I'm just like hopefully like this coming week we'll complete it. So I mean the rates have been rising a lot, so it's been unfavorable. So but
yeah, what is it looking like for you?
Like a 1.0 DSCR right now. So renting for 3,200, but then it's basically kind of interest only payments for 5 years, and then like so basically like you want to exit, but the plan is to exit within the next 5 years, and so it's like even cash flow 3,200 basically gets me I think close to like 1.0 DSCR as far as like the loan terms.
Okay, so the plan is to refi and then 1031 into a commercial property.
Yeah, typically you gotta wait. The right way to do it is to wait 2 years before you can sell on the market. I mean, I know there's people who say like you can sell it the next day if you didn't intend to like hold or whatever, but it's just like a gray area. So I just gotta play by the rules and wait 2 years and then 1031 into like a commercial or cash flowing asset. And so
yeah. And did you finance the the gap for the fix and flip?
Yeah. So,
Okay.
Yeah.
Cool. Nice. I like it. Did it change from your projections going into the deal and then now going for the DSCR loan? Did your projections change for the DSCR loan?
Yeah, it definitely changed. And then the rates, even while we're in the middle, while the loan's happening, right? I think like in commercial, you can't really lock in like your rate like you can
Yeah.
in conventional. So it's continuing to rise. And then it just continued to rise. And in the beginning, it was like looking like it's okay, like DSCR, but it's getting worse and worse and worse. But worst case scenario is, so now like whether or not you want to go principal and interest or just interest only. But then there's also some products out there that will do like negative DSCR. So you can actually be like 0.8 of your in worst case scenario, you're just gonna pay more points and their interest rates gonna be higher, et cetera. And so
Yep. I think we're looking at another partner that has a negative DSCR. And do you know what it was, Alex?
They just allow negative DSCR, so it can be below a 1.0.
I think that might be like very valuable for our investors in the next coming months because of the high raise, the interest rates are like rising, right? So like initially, like we thought, okay, we'll be like, okay, but as the interest rates rise, that affects your monthly principal payment or interest only payment a lot. So then now like you're looking for like a potentially 5 to 10 year hold of just a negative DSCR until the rates either drop or you can like 1031 into like something else that has like a higher cash flow asset, right?
Yep. Totally. Thanks, Daniel. No, that's great to hear from like experience that you're going through right now, right? That it has changed. It sounds like it's gonna keep going. So I think the people who are trying to wait for the rates to come back down, they might be waiting for a while.
Yeah, definitely.
Yeah. But in the NPLA, from what I heard when I was on the call, it does sound like they are predicting that they're just trying to find some sort of pattern right now that works so that the rates and everything can kind of stabilize. Because right now it's just bumping, and then it's mostly going up. So up and to the right. So they're trying to find where is this thing going to settle so that we can start because one of our clients that is bringing a lot of business, they want to they're asking if we can rate lock, right? And we, especially right now, we cannot, not even like 7 days ahead of closing because it's been changing so much. For the bridge loans, it's not volatile and it's not changing that much or that quickly, but it is changing. We went up like 50 basis points, I believe, on R4 for fix and flip and ground up. So just be prepared that even the rates for the fix and flip and ground up might be going up soon. And has anybody experienced that for any of their fix and flip loans? Nope. Okay. All right, guys. Well, does anybody have anything before we kind of wrap up today's call and we'll head to Easter?
I do.
Hi, Ann.
Hi. I'm hiding from my kids in my car. So I don't know what.
I love it.
I have a 13-year-old and a 2.5-year-old, so I'm definitely hiding in my car. So if we could all like get in our time machines and go back to like the very beginning of when you all started, because that's where I'm at. I was talking to my property manager for my single family home in New Mexico, and I was just trying to refamiliarize myself with the area. I haven't lived there in a long time, and this is a new company that took over, so I really had never spoken to him, only through email. Okay, so there's a little bit of the backstory. And I had mentioned, like, so what's the rental market like there? Who's doing what? Are you guys doing traveling medical professionals, or what are you seeing as the property management company? And eventually it got to, are people doing like abandoned buildings, turning them into condos or apartment buildings? Like, is that a thing? Because the town is very small, but it's surrounded by a very large Air Force base. So, in a cheese plant. So those are like the major contributing jobs there for the town. So I said, who's doing what? And he said, well, you know, speaking of abandoned, there's a 36 unit apartment building here that was purchased and they haven't really done anything to it. So as a beginner, I ripped the Band-Aid off as far as like analysis paralysis. I was telling Tay, but now I don't know what to do with like leads. I'm in like opportunity paralysis. Like I don't know what to do with these opportunities. So I look on PropStream. I'm like a beginner on that. I look on PropStream and it's owned by someone's self-directed IRA. So then I click on that address and it's like a corporation. So what I'm looking for is, are we saying, Anne, this is a little bit out of your league, stick to the duplex you're about to close on this at the end of this month? Or are we going to like, let's help her out and let's partner and let's see what we can do? Because I would really like to help the community on this eyesore. And I would also like to help myself and the property manager, who is an amazing company, type of deal, like the help me, help you, help me. So
Right.
I'm looking for help on how to like reach out to who I need to reach out to on at least knowing if I should shut the door on this or if I should just continue pursuing.
Okay. And
Am I being
it's
clear, or am I still in the
Yeah.
glory of hiding from my children? Okay.
No, I understand, and I understand on both ends of that. Oh, sorry about that.
No
I didn't know
worries.
it was muted. No, I understand, and I think, and maybe we can put you in touch. Myself, me, Alex, and Kikoa. I think if we just dive in a little deeper, we can see how we can help to see whether or not we should close the door on it or actually open it up. I know we're actively looking for more projects like that. I mean, we've never considered New Mexico, so it's probably something we may not be able to come in right now, but you never know.
Sure.
And we have a large network that even Kikoa kind of utilized when he was closing the big apartment complex that we had in Vegas. So we'll help you take a look at it, because yeah, it's kind of hard
Okay.
to tell without too much detail. But
Sure. And
If-
Clovis, New Mexico is not Vegas, just so you know. It is like Texas Panhandle, and the town is only like maybe 34,000 people. However, they cannot keep rentals. Like my house, it's a single family, it's nothing special. It's built in 1975 and it was vacant for like 2 weeks. Like they barely had time to like go in and clean and put in a new refrigerator for me, and people wanted to live in it. And it's not even like amazing. It's not luxury. It's not anything great. So because the town is kind of, not great, people come there as far as military goes. That is my background. People come in there and they're like, I am not buying property here. This is just a one-off base. And so they just want to rent and get out of there in the 2 to 3 years.
got it.
Yeah. So that's kind of the background of that transient area for you. And then we can just talk offline.
Perfect. Okay. Yeah, and
Okay.
that goes for everyone else in the room too. If that piques someone's interest, maybe they know someone in that area. I don't
Sure.
know.
Sure.
Feel free to reach out to Anne. And Anne, I don't know if you're comfortable sharing your information, but
I
you
totally
can
am.
drop it.
Yep.
in the chat. Yep. Yeah. So maybe
My toddler
Oh.
could reply on his fake laptop to any emails.
yeah. Well, we can catch up after too then.
Sure.
And why don't we'll talk about it. But if anybody else is interested in helping out or helping Ann out, then feel free to reach out. And I think we'd like to take a look at it. If the property's in distress, or if the owner's in distress, or both, then it's something worth looking at to see if
Sure.
we can help. So
Yeah,
Okay.
the property manager said the first lady owned it for a long time and then just ceased all property management, and then it just went downhill from there, went to auction, and then this new owner, whoever the self-directed IRA is, has had it and has done minimal anything to it. So who knows? I don't know the ins and outs of like who hides their money where and why. And, you know, I'm that much of a beginner. So I appreciate any help.
Yeah, of course. No problem. So we'll reach out to
Thank
you,
you.
Ann.
Okay,
Thank
I'll
you.
drop my information in the chat.
Perfect.
Okay,
Awesome. All right, guys, let me just answer one more question. This is from Monica. Hi, Monica. Just wondering if you guys are seeing longer months for closing, longer holding period. Definitely longer for closing on the purchase side if you're required to use an appraiser. Excuse me. Longer periods holding it, I haven't seen anybody affected about the holding times during the project, but if it's like a fix and flip, perhaps maybe I would say be prepared for longer holding times when you're going to market. If the interest rates continue to rise, then the buyers are going to lose power a little bit. So it may affect your holding time on the back end, but I haven't seen anything different yet. Has anyone seen anything different in their projects? Nope. So far, so good, I guess. But yeah, no problem, Monica. All right, guys. Well, I hope you guys all have a great Easter and get to enjoy time with your family. Happy Aloha Friday, happy Good Friday, and we'll see you guys next week. Aloha, everybody. Hey,
Yeah.
Ben, before you log off.